Hello everyone and welcome to Business Hub. Risk management in investment is a crucial aspect of the investment process that involves identifying, assessing, and mitigating potential risks to protect and potentially enhance the returns on your investments. Effective risk management helps investors make informed decisions, safeguard their capital, and achieve their financial goals. Here are key principles and strategies for managing risk in investments. Number 1. Risk assessment. Risk tolerance. This assessment involves evaluating your willingness and capacity to handle investment risk. Willingness depends on your psychological disposition and comfort level with market fluctuations. Capacity is determined by your financial circumstances, including income, expenses, and other financial commitments. A risk tolerance questionnaire or discussion with a financial advisor can help you pinpoint your risk tolerance level. Number 2. Diversification. Asset allocation. Asset allocation is the process of determining the right mix of asset classes, e.g., stocks, bonds, real estate, in your investment portfolio. It is based on your financial goals, time horizon, and risk tolerance. A well-diversified portfolio helps balance risk and return. For example, stocks generally offer higher returns but come with higher volatility, while bonds provide stability but lower returns. Geographic diversification. Different regions and countries have varying economic conditions and political stability. Investing globally can mitigate the risk associated with being heavily concentrated in one market. Exchange-traded funds, ETFs, and mutual funds that track international indices can be used for geographic diversification. Sector diversification. Economic cycles affect industries differently. Diversify within asset classes by investing in various sectors. For instance, technology stocks may perform well in a booming economy, while healthcare and utilities can be defensive during downturns. Number 3. Investment horizon. Long-term versus short-term. Your investment horizon plays a pivotal role in risk management. If you have a long time until your financial goal, e.g., retirement, you can afford to take on more risk since you have time to ride out market fluctuations. Short-term goals, e.g., buying a house in a year, may require a more conservative approach to avoid potential losses. Number 4. Risk assessment and research. Fundamental analysis. This involves a deep dive into a company's financials, management, industry, and competitive position. Analyzing financial statements, income statements, and balance sheets can help assess the health of a company and its growth potential. Technical analysis. This method involves studying historical price and trading volume patterns to forecast future price movements. Technical analysts use charts, patterns, and indicators to make investment decisions. Number 5. Stop-loss orders. Types of stop orders. A stop-loss order is a preset order to sell an asset if it reaches a certain price level. There are different types, including market orders. Sell the asset at the current market price once the stop price is triggered. Limit orders. Sell the asset at a specific price or better once the stop price is reached. Trailing stop orders. Adjust the stop price as the market price moves in your favor, helping you lock in gains while allowing for potential further price increases. Number 6. Risk-adjusted returns. Volatility and standard deviation. Volatility measures how much an investment's price fluctuates over time. Standard deviation quantifies this volatility. Higher standard deviation indicates greater price variability and risk. Sharpe ratio. The Sharpe ratio compares an investment's return to its risk, volatility. It helps you assess whether the returns you're getting adequately compensate for a level of risk you're taking. Number 7. Liquidity management. Emergency fund. An emergency fund is a cash reserve set aside for unexpected expenses like medical bills or car repairs. Typically, it covers 3 to 6 months' worth of living expenses, ensuring you don't have to dip into investments during emergencies. Asset allocation for liquidity. While long-term investments can remain less liquid, you should allocate a portion of your portfolio to liquid assets like cash and short-term bonds to address short-term financial needs. Number 8. Risk-reducing strategies. Dollar cost averaging, DCA. TTA involves investing a fixed amount at regular intervals, regardless of market conditions. It reduces the impact of market volatility on your investments by spreading purchases over time. Hedging. Hedging strategies involve taking positions that offset potential losses in other investments. For example, buying put options on a stock can protect against price declines. Number 9. Continuous monitoring. Rebalancing. Regularly review your portfolio to ensure it aligns with your target asset allocation. When certain assets outperform or underperform, rebalance by buying or selling assets to maintain your desired mix. Periodic review. Your financial goals, risk tolerance, and market conditions change over time. Periodically reassess these factors and adjust your investment strategy accordingly. Number 10. Professional advice. Financial advisor. A certified financial advisor can provide personalized guidance based on your financial situation, goals, and risk tolerance. They can help you construct and manage a diversified portfolio that aligns with your objectives. Number 11. Behavioral discipline. Emotion management. Emotional reactions to market fluctuations can lead to poor investment decisions. Staying disciplined means sticking to your investment plan, even when emotions urge you to buy or sell based on fear or euphoria. Number 12. Regulatory and compliance considerations. Tax laws and regulations. Stay informed about changes in tax laws and regulations that may impact your investments. For example, tax laws can affect the timing and tax treatment of capital gains and dividends. Effective risk management is a dynamic process that requires ongoing attention and adjustments as market conditions and personal circumstances change. By implementing these strategies and principles, investors can better navigate the complexities of the financial markets while working towards their long-term financial goals. This is it for today's video. What do you think of our video? Comment below with your thoughts and let us know. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.